Hi, good morning. This is Hyperwave. We have missed you guys. And yes, it is the same exact time as the World Cup. So we recommend having both on at the same time, and it will be a practice in multitasking. I have this going on the side. To answer your question, we do have Thor, but he looks like a dead dog. We'll see if he wakes up on that one, but he is joining us today. So today's gonna be really interesting, and yes, we're actually gonna try to cover all these different topics. So because we've missed you guys, and specifically, this is me trying to summarize. Sorry if I don't get to everything today. We can make another of all your different questions, synthesize them into specific and hopefully a small amount. So you guys have been sending incredible questions through. I hope that I do a good enough job today. We are covering traditional markets, so US stock markets, but also international stock markets, because China is officially in a bear market right now. So how will that affect everything? Yes, lots of questions about GBTC and a lot of questions about silver. So finally, we're going to cover silver, gold, because it's interesting, obviously, and with Bitcoin price action, but we're going to run the gamut. So again, should be a little fun. Tyler, we missed you.
Well, thank you very much. I've been moving things again. Took a 700-mile trip yesterday, bringing boxes and boxes of research and papers down from Pennsylvania, which I had moved from Manhattan, which I had moved from Long Island, and about 1,000 books. I donated another 1,000 to a bunch of libraries out on Long Island, which I hated to do. I'm glad for the libraries, but I miss every book. I know all of the titles. I know what's in them, and it's like losing a friend when I finally cut loose. But all of that is now over, and I am ensconced in my new location, and I love it. And Leah and I are getting back to, Lisa keeps popping up because we've got a Lissy, and we've got a Lisa, and we've got a Leah, and Lissy and Leah are, or Lisa and Lissy are consulting clients, and one of them has also joined a group that we have called Hyperwave Research, which you can find out more about by contacting Leah, which is a fascinating group. And we will try to answer some questions today from that group also. Now, obviously, we can't go in depth on 11 different topics. However, you will be surprised at how much depth we can get into, because all of those topics are related. These are not isolated topics. When we talk about fundamental analysis and technical analysis, they are not unrelated. When we talk about Bitcoin and gold and silver in the US stock market, they are not unrelated. When we talk about interest rates and credit and debt and central banks around the world, they are not unrelated to all of those other topics I just talked about. So when I say in depth, what I mean is we're going to try to tie all of these disparate things together by answering your questions. Now, Leah has been terrific about writing down your questions so that we can get to them. And when we get 6 or 8 or 10 or 12 on the same topic, then we put them into a little basket, and those are the baskets we're going to talk about today. These are all questions that you have all had about various topics we've talked about. And I want to show today how they are related from my perspective, which is a very different perspective than a lot of other people have when talking about cryptos and Bitcoins. Because cryptos and Bitcoins, to me, are just one little tiny piece of a very much larger puzzle that puzzle will affect all of you over your lifetime, which has to do with our topic about money management and the value of assets and what you actually have compared to what you want to get, what you have been able to collect at age 15, age 20, age 40, age 80, age 100, what you have collected that you consider to be your property, your assets. And there's a way of looking at those assets to either change them or to move them around in such a way that it's more comfortable for you, the way you look at the world. And you look at it differently than everybody else. And you certainly look at it differently than I do and Leah does. Everyone's individual. And we're not talking to individuals now. We're talking to a collective group that tend to be around 3, 4, 5, 6, 7, 10,000 people who are just hearing two people talk about various subjects. So you know the subjects that we talk about and you ask questions about them. But we understand that those questions are meaningful to you, not only relative to that topic and that question, but relative to this much bigger picture of, okay, all of this stuff is related. The stock market is related to other asset classes, stocks, bonds, and cash, which are related to newer and riskier things where you can make a lot of money, but you can lose a lot of money, like cryptos and bitcoins and gold and silver and rare earth materials, uranium stocks, nuclear power, solar energy. All of these are very unique new innovations. And we started these vlogs talking about one in particular, Bitcoin and crypto. And we will continue to do that because to me, it's the most exciting of all of that stuff. And not only all of that stuff, but all of the stuffs that I have studied going back thousands of years in terms of this topic of what is it that attracts us to things that we don't have, or things that we think other people have, or methods that other people have had to increase what they have, and I haven't figured it out yet. And all of that has to do with our values, you know, what we believe about ourselves, and the best roads to get to what we want and be happy with the way we've gotten it, and hopefully have helped other people along the way. Okay, long introduction, but I just wanted to give you a scope of what we're going to try to do today. And now I'm going to turn it over to Leah to begin the presentation of various questions and her responses to them and my responses to them. Leah.
Perfect. And I guess just also following up here, yes, volume lower, is also we're going to start covering prescient news items. And Tyler and I can discuss that a little later when we bring one of them up that we've been asked about. And again, just because as more fundamentals will, especially fundamentals, you know, have very important ramifications for traditional markets, but also regarding money management, and I'll just leave it there. It'll be a fun surprise. So one of the biggest questions that I get, and it's usually worded in lots of different ways, so I hope that this is a good synthesis, is, Tyler, how can you say that Bitcoin is acting or will continue to act like all other hyperwaves when it's really so different than any other asset class that's ever existed?
Yeah, it's a great question. It's a valid question. And we've gotten that from a number of different sources. In general, I believe it is misguided as an understanding, or not an understanding, but an opinion or a belief. An opinion or a belief that nothing this fundamentally important has come along in your lifetimes, my lifetimes, and possibly ever in history. In one sense, I can potentially agree with that. But that sense is purely theoretical at this point. And something that is purely theoretical and doesn't have a basis in fact in terms of proof and evidence will be recognized by most people, the vast majority of people, as being illusory, as being not true. And that's what we've got going on right now. We've got a very tiny group, which has grown but is now shrinking, of true believers. Because true believers in Bitcoin did not believe that what we have been going through for the last 6 months could happen. They thought that maybe in 2014 and earlier, when we had these vicious bear markets, that was just because it was so new and there weren't many people in it and it was very illiquid. But I know for a fact that the great majority of those true believers, as we got up to 20,000, never believed, never thought that this new asset class could do what it has done for the last 6 months. And if some of us are correct, Tone and myself and Van Zen and others, we are not at the bottom of it. It doesn't matter to me if we're at the bottom or not. It has already proven absolutely to me to be exactly the same as all other asset classes, from the perspective of being able to analyze it technically and fundamentally. Exactly the same. It did what it should going up. It did what it should going down. It was predictable. It allowed me to make, I believe the last count is 13 out of 16 correct short-term calls in the next 5% movement of this particular asset class. It allowed me to call the movement up to 20,000, the end of the movement, and the movement down to the current level. That's enough evidence for me that this is the same as all other hyperwaves. Now, there are funky hyperwaves and there's funny things that happen. We've got a group that is doing a remarkable job of coming up with new hyperwaves. Just remarkable. Crypto Pig, Crypto Sweet, or Sweet Pig.
Sweet Pig.
Specifically is just gone nuts. He's a monster. And he's come up with 20, 30, 40, 50, I've lost count, of current hyperwaves in various areas of development. GBTC has been doing this for the last 4 months, even before we started the group. If anybody's interested in that group, you need to apply through Leah, and then the group will take a look. And basically, you just have to really be helpful and interested and willing to work to, we'll give you hints on where to look, but we're going to limit that group because it's very efficient right now. But we would love anyone that is interested. It's not to learn hyperwave, although everybody in it is, including myself, learning about hyperwaves. It's to do the work to find them, historically, currently, ones that might develop in the future. Okay, but in any case, the answer to that question is this is no different than any other asset class. I will concede that it could become different, but up till this afternoon or this morning, it is not. It is acting exactly the way it should. The sequential trading system is killing it, is picking out all the turning points, all the nines. Hyperwave is killing it. The Consensio is killing it. Killing it meaning that the consistency of those systems when applied to other asset classes have not wavered in applying it to this, Bitcoin. Now, cryptocurrencies is different. And I told you that from day one, that I'm not even attempting to apply technical analysis to the vast majority of them because they are invalid. They are not true assets. They were built fraudulently, they're run fraudulently, they're manipulated fraudulently, they're traded on exchanges that are manipulated fraudulently, they're hacked all the time. It is nothing to consider. For those of you that like to speculate and jump in and out of things, that's probably as good as any area to do it. But that has nothing to do with money management, nothing to do with investments, and nothing to do with true asset classes.
Ty?
Yes.
Great. As a follow-up to this one, I usually also get a question regarding the finite cap. Now, let me elaborate. Thank you, Sweet Pig. Which is that his question, and I think it's great, is what does Hyperwave, I'm just going to do the whole one. What does Hyperwave have to do with commodities, which are not such as sugar? My favorite is orange juice, futures, just kidding. Commodities, non-earth shattering innovation, something you can grow in the backyard. And again, let's just extrapolate that a little further, which is, I think, where a lot of people try to go, which is just the finite nature of Bitcoin. So very related to what you're saying, but making it a bit specific.
Yeah, it's a great question because it moves from the Bitcoin to a very large class called commodities. Commodities are not very well understood by most investors. But they are all limited in supply. I have made the point that everything in the material world is limited in supply, including the number of atoms, neutrons, neutrinos, electrons in the universe. It's limited. It's big. It's a big number, but it's limited. When you get down to planet Earth and resources, they are all limited. The number of shares available in Tesla is limited. The number of shares of Berkshire Hathaway is limited. The number of stocks in an index is limited. None of them are infinite. So you've got different sizes of asset classes. You've got very tiny ones like rare earth elements, which are not really rare. It's just that they're so darn difficult to get out of the ground that the supply is very limited and very few people waste the time and the money to get them. But it's a very exciting area for the future, but a very limited way of being able to invest in it and all of that sort of thing. Commodities are limited but knowable, and that's all you need to do any kind of technical analysis. Gold is a lot more limited in supply in terms of it's generally rare compared to iron, for example, and compared to other things. But more than that, it does not appear in huge quantities in small places. Oil is very difficult to get to, but once you find it, and we've come so far in being able to find it, that when you do find it, it's available in enormous supplies. Getting it out is difficult and costly, and you've got to go deeper and deeper and come up with new ways and all that sort of stuff. But the agricultural goods are very limited by a lot of things. You say, well, I can grow corn in my backyard, but you're not. Why? Because it's a pain in the butt. Farmers get into various crops because they've got the land to do it to scale, and then they have to change the crop because of supply and demand, and also it helps in the replenishment of nutrients when you change from one type of agricultural product to another. Those things are all tracked and have been tracked forever by all kinds of analysts. You can get very good information on all commodities. All commodities move price-wise in very predictable patterns that can and are tracked by technical analysis. That's where most technical analysis came from. Candlesticks came from rice. Most of the systems that I've talked about that Wells, Wilder Jr. and others looked at, the sequential system originally, all came from commodities. The people that were studying them used the commodity markets and were experts in commodities. And then they spread to other asset classes because they work with other classes. And what I'm telling you today is they work with all commodities. They also work with Bitcoin. So I guess that's my answer.
Thanks, Ty. And sorry, guys. Yeah, my broken knee really hurts today, so I'm gonna probably sit in weird positions. Tyler's also, I think, evoking the fact that my mother's family, well, actually, my mother grew up as a corn farmer, and my family in Iowa from my mom's side are still corn farmers. And on that, and to your point, which I find very interesting, and into the next question that I'm going to ask, that I'm interested in, is that specifically, at least two of my uncles, corn farmers, that had a lot of corn, a lot, they did well. But not everybody else did. But their opportunity cost, they switched due to government policies and subsidies from corn farming to almost all solar powers. And they were paid by the state. And that was obviously a very big policy decision that was made that affects supply demand on just a very basic level of economics. So I do find what you're saying particularly interesting, and I'm sure that you could also speak to how things can be in that world manipulated on a policy level, and then also, therefore, probably the very importance of following the fundamentals of what's going on here in Washington, D.C.
Absolutely. Commodities in general, just think about them, break them down into their categories. Now, commodities are different than futures. All commodities traded on an exchange use futures. There's also cash commodities where you simply take it to market, the farmer does, and sells it at whatever price they can get. But the futures market was really developed for farmers, for agriculture originally, because of weather and mainly rain, but also temperature that is can devastate those attempting to be in the agricultural field. And it is a way of getting a price today for something that you own today, but you can't collect on. When you plant something in the ground, you have to wait for it to grow so that it can be harvested and taken to be sold. That's true with the oil market and the gold market. A gold mining operation on day one has no gold. You have to go and get it. You know what the price is going to be and the amount of time it's going to take you to get it, but you don't know what the price is going to be when you can finally get it. So you can sell it forward in the futures market. That's what commodities are all about. But I said that futures and commodities are two different things, because in the 1970s, we added a number of other things that you can't touch, feel, smell, or drop on your foot, such as stock indexes, bond indexes, individual bonds, mortgage bonds, options on all of that paper. So the options market started really developing in the 1960s and 70s. The futures market having to do with financial things like currencies, like the dollar, all the indexes of the world, the Japanese stock market, can all be bought on commodities futures exchanges. and sold on them. Well, then why did all this technical analysis develop from the commodity side? The answer to that is the way the futures market is set up, you can leverage an enormous amount to the amount of money you actually have. When you buy a stock, the most you can get, and I'm not talking about an option or a futures on a stock, I'm talking about the stock itself, Tesla stock. You can open up an account where you can margin 2 to 1, basically, your money. So you can put $100,000 with a broker and buy $200,000 worth of Tesla stock. And that $200,000, you owe $100,000 and the interest on it back to the broker at what's called the broker call rate. Okay, so you can leverage your money 2 to 1. You can buy an option or a call on Tesla stock and get much more leverage, 5 times, 10 times, 20 times. But the futures market is magic in terms of being able to leverage. In the days past, I've been able to buy $1 billion worth of treasury bills with $10,000 in capital. It can be 100 times. It can be more than 100 times, just the way some of the crypto exchanges allow you to go up to 100 times. Now, what that means is you better darn well know what you're doing. But these guys that developed, the Wells Wilders and the Larry Williams and many, many others that developed these systems knew what they were doing. And they used technical analysis to help them know when they should increase their position sizes, increase their leverage in order to really do extremely well. And almost all big commodity traders have employed and hired partners who were particularly adept at technical analysis, because a lot of the old time traders in commodities were not. They had to learn it, but they knew the fundamentals backwards and forwards. They knew supply and demand. They knew the weather. They knew meteorology. They knew all the details. The fundamentals in gold mining have been known for years and years and years. And it wasn't until technical analysis came along and then the futures market allowed us to leverage it for it to be done in a very efficient way. But again, you've got to know what you're doing. 95% of everybody that jumps into the futures market loses all their money.
Tyler.
Yes.
I know I always cut you off mid-train, but you're good at this. Just as a follow-up, while you continue in this train, as you keep saying that you need to know specifically what you're doing if you want to invest in this, maybe can you also elaborate on what you mean about that? What should you be looking at from an investing perspective to know what you're investing in so that it's not dangerous?
Absolutely. That's the key question that ties all these other questions together from my perspective. Because my perspective is going back to each one of you, just each one of you who are listening or will listen later to this vlog. Picture in your mind what you have today and put it into US dollar terms. Put your Bitcoins, any junk cryptos, put your real estate, put your checking account, savings account, brokerage firms if you've got it, retirement accounts if you've got it. If you've got a significant other, put that with it too. If you've agreed to jointly share it, get a mental picture of that number and get as specific as you can. If it's $140,982, that's specific enough. And just hold that in your mind. That is the sum total net. And I'm talking about net numbers. I'm not talking about gross numbers. What I mean by that is take all the liabilities that you owe on your credit cards, your mortgage in your car, on your insurance policies, all the rest of it. Those are liabilities You owe that, subtract that from those assets and get a number. Now that you have that number has been growing or shrinking every day since you were a day old. It will continue to do that until you are no longer an earthly presence. It is the basis of almost everything you are able to do or accomplish in your life. And I'm not saying that money is everything. I'm saying that it ties into everything. Your emotional well-being, the well-being of your relationships, the well-being of your health, the well-being of your self-esteem, the well-being of your business plans, the well-being of the job that you now have and are thinking about other things because of dissatisfaction. If you take all of those elements, they're all tied to that one number that is now hopefully sitting in your head. What I'm telling you is protect that number. That is what money management is all about. It's not about the newest, hottest thing that everyone's talking about. It might be, but it only should have a minor influence, because what you need to do is whenever you decide to convert any of that dollar amount into something else, into a meal, into a vacation, into a share of Tesla stock, into Bitcoin, into cryptocurrencies, into silver, into your retirement account, whenever you make the decision to take some of that money and move it out of dollars into another asset, you are talking about investing, speculating, money management, which has two basic ways of allowing you to come to the conclusion of the amount of risk you are taking relative to the amount of reward you are trying to get. And those two basic ways are fundamental analysis and technical analysis. You can do either one of them. You can do both of them. If you don't do either of them, you are going to make a bad decision. It might work out, but the next one won't. It might work out 3 times in a row, but the next 7 won't. That gets to this idea of coming to a conclusion about risk versus reward before you make your decision of reaching into that stocking or under the mattress or into the checking account, taking some of those dollars out and doing something silly or reasonable or well thought out and intelligent with that. That's the definition of money management.
Ty, I want
Yes.
to take this further. My own personal question. So taking what we're talking about, money management, and to the institutional level, because obviously as an asset manager and with an asset management firm, you often manage large institutions, even large nonprofits, etc. What I learned in business school, obviously, well, not obviously, and also running my own company, is that sometimes it's not, and this is, I will tie this back, how much profits you're making, but specifically in regards to risk reward, the internal rate of return that the investors are expecting. So, and that's relative. So, and shareholders. So let's say your shareholders are expecting a very high dividend rate. They expect to be paid back the amount that they want is different with each company. And that's often calculated, and with a lot of these calculations like CAPM. So I guess the question, turning it back to you, is given that we're talking about a very relative to each person's desired return, how are you thinking about and calculating your position sizing, and also just what you're moving into from a beta, from a risk and also risk reward ratio perspective, from the institutional level, as well as then, and if there's differences and similarities in your eyes, the individual level who's using you for money management for their own, let's say even 401k.
Yeah, excellent question. And unfortunately, the answer to that is institutions have an enormous advantage over you as individuals. Unless you as individuals have a very strong background in all these topics we're talking about, and that's one reason Leah and I are doing these vlogs. Because what we'd like our listeners and our followers to begin to assimilate over time is just the conceptual side of all of this investment stuff. Institutions are already there. Most of the individuals in the institutions don't have a clue about what it is that they're asking, so they turn to outside help. What I'm saying is very well-educated trustees, very well-educated and experienced members of boards of directors, being educated, being intelligent, and being experienced have nothing to do with the financial markets. It probably gives you a leg up on learning about the financial markets, but it is wrong to assume that doctors, medical doctors that are very proficient in what they do know a thing about investing. I will tell you that they don't. They are one of the worst groups to deal with because they assume through their intelligence and their experience that their opinions matter when it goes to things that they know nothing about. The second group are lawyers. Lawyers I manage money for, over the years, a number of law firms, their pension funds, their profit sharing plans. And individually, they are the same as you and me, and Leah. The only way you get experienced in financial matters is to be in financial matters. Doesn't matter if you're the greatest tennis player in the world, greatest football player in the world, greatest soccer player in the world, greatest singer in the world. You will tend to lose all of your money because you assume, oh, I'm smart and I'm great and people love me, therefore I will do all of these crazy things. They are unrelated. Okay, off topic, but important to note. Institutions, though, have been around for years and years and years. That's why they're called institutions. They have all kinds of formal things that are set up. They know what they don't know. They know what they need. So they have actuarial assumptions, but there's no one at the institution that's coming up with those numbers. They go to outside CPAs. They go to actuarial specialists. They don't know anything about what to do with their money, so they go to pension consultants. They go to people like me to manage their money. And people like me have to respond to pension consultants who have set up certain parameters for the institution, what they can and can't do based on risk and reward of various asset classes. And then they hold me responsible to stay within those risk reward parameters. And then the actuaries set up numbers that they need to hit all of the numbers they need to do in their pension fund so that when somebody retires 50 years from now, money will still be there. That's the way the whole institutional thing works. So it's very regimented. Each party involved in that process is offended by and dislikes what the other parties are saying because it restricts what they do. I, as a money manager, will push the pension consultants and the trustees to change their asset allocation, and they will do it to a certain extent, but not to my satisfaction. The actuary will say, you guys have got to do 7.5%. The pension consultant will say, I don't think it's possible to reach 7.5%. And the money manager will say, either it is or it isn't. And the trustees will vote on it, and they will come up with a mix of everybody's ideas. That's what you need to be doing with every decision you make when you reach into your nest egg and decide to pull some of it out to do something. You're not going to do that, but you need to be thinking in those terms and then constantly reevaluating that until you get to the point that you understand how it all works, and then you can do it also. You can play all of those roles. And that's the responsible way to manage your money.
Thanks, Di. Following up on growth and a very minutia question specifics. So for the more advanced people in this chat, I assume you guys are going to love this one and a couple of the others that I'll follow up with. What effect does growth and value ratio have over the index, if any? Yeah,
great question. By the way, it's France 1, Argentina 1 at the 44-minute mark. Okay, growth and value, the most misunderstood and impossible to define terms in all of investments. Anybody that uses the term value or growth, it's jargon, it's often meaningless, but you are not going to be able to get away from it. So let me try to summarize the difference between growth and value. The S&P 500 is supposed to be made up of approximately equal amounts of growth and value stocks. Nobody has said that, but over the years it's developed in that way. And here's an easy way to think about it. You take the 500 stocks in the S&P 500 and you assign each one of them a price to book value. Now, I don't want to get down in the weeds too much. This is fairly simple stuff, though. The book value of a company is basically all of the assets minus all of the liabilities, and then there's short-term and long-term of both of those things, and there's all kinds of other things that go into it, but forget about that for a moment. It's if you liquidated the company today, what is left? Kind of what I asked you to do with that calculation of your value. That's your book value. All of your assets minus all of your liabilities turned into US dollars. That's what the book value of a company is. You can look up book value and get a lot more detailed. If you've taken accounting courses and stuff, you can do that. But let's just grant me for this illustration that definition. So now what you want to do is you want to assign the price to book ratio, the price of the stock divided by the book value of the company will give you a number. And then you're going to rank all 500 companies in the S&P 500 from the most expensive, the highest price to book, to the least expensive, number 500, which will be the lowest price per share per book value. Okay. Now you got 500 companies ranked from 1 most expensive to 500, all within an index. Now cut it in half, 250 above the line, 250 below the line. Everything below the line is a value stock. Everything above the line is a growth stock. There's your definition.
I had myself on mute. Good. Well, let's continue with definitions because, and also in the live chat, but we agree and continually stress the importance of definitions. So I'm going to ask you about value investing versus activist investing, activist hedge funds. And this is, again, my own personal question for you. Hope you guys will indulge me on this. So the importance of, in my eyes, of learning your own systems is also learning from experts. We read all these crazy books Tyler has behind me of 1920s technical indicators, as well as others, as well as learning reflexivity, understanding how brilliant investors from all spectrums, from hedge funds to money management to venture capital, think about their investments. And two main thought leaders, and also what you will see in the markets is just the value investing perspective versus activist hedge funds. Now, this is a personal question that I'm curious from Tyler, because we haven't talked about it too much. Is my own personal background is I did work for a very prominent activist investing hedge fund. So it was a very, very different, very specific, not only way of looking at investments, but also managing them. But that's also different than money management. But what is your opinion and thoughts on how people who are making their own decision on what to invest in should follow experts, and how the difference between the definitions, difference between value investing versus, I'll just say, activist and hedge fund, and how they think about their investment strategies, and how we should potentially synthesize or learn from those experts and what's going on in the markets, and following them and their investing strategies. And I'll leave it there.
Yeah, great question, and one that I ran into over and over and over again the years I've been doing this. I'm going to make some very definitive statements. I will not go into the explanations of why I'm making them, but as soon as the best way to be an investor is to keep an open mind about everything. Everything having to do with taking dollars and putting them into an asset class. Your first question is, how am I going to limit the asset classes I put those dollars into? I have some clients that deeply believe in certain subjects, such as the environment, and they want a certain proportion of their assets put into things that are supporting lower use of fossil fuels, greater use of renewable fuels, greater exploration into cleaner water, controlling deforestation, on and on and on. Now, when anyone comes to me and they say, okay, I have this pair of handcuffs and I'm going to put them on you and put your hands behind your back so that you can't reach all of the tools that you believe, Tyler, to be important for me, the client, in managing my money. That's what you have just done by limiting my scope of being able to get you the best rewards for the lowest risk. Now, I understand that completely, and I happen to agree with those individuals on the environmental issues in terms of, from an investment point of view, because so many people have bought into this concept of the degeneration of the environment that can be controlled to a certain extent by humans, that they are putting enormous amounts of money into accomplishing that. That makes that a good investment. If you just understood what that train of thought was. The train of thought was, what was not a good investment 10 years ago has become one because of the adoption of the belief of experimentation for coming up with more efficient ways to limit carbon emissions. So those companies then began to get more and money flowing into them from governments and private, and that makes them a good investment. At some point in the future, they will not be a good investment. They became a very bad investment about 10 years ago, even though it was heating up and everybody was jumping on the bandwagon. But technically, they became a very poor place to put your money, and they crashed. Solar stocks and a lot of other things crashed. But then they became a very good investment again, and over the last 3 or 4 years have begun to soar. But that's the way I like to look at it. Okay, the Catholic Church has restrictions on the investment of their dollars in their retirement accounts, in their church coffers, having to do with Catholic principles. So when I manage money for a diocese, one of the they have a number of restrictions, but things having to do with the principles of Catholicism in terms of anti-abortion, in terms of weapons, sometimes in terms of the use of alcohol, a number of different things that restrict a money manager in what they can and can't buy. That's activist investing. That is making decisions a priori, the decision to go ahead and take the dollars and do something with them. There are many, many examples of that having to do with beliefs that people have. They don't want money going into gun manufacturing stocks. They don't want money going into oil and gas companies or fossil fuels. They don't want money going into nuclear. They don't want money going into on and on and on. You come up with the subject matter. There are groups of people that want restrictions on what they are willing to do. That's fine. But rule number one, as soon as you put a restriction, you have limited your returns, period. I don't care, period. As soon as you restrict what you can buy and sell with those dollars under your mattress, you have limited your potential return. Okay. Now, you have to offset that with your own personal values. I don't care if instead of 10.5%, I can only get 9.5%. I'm willing to give up that 1% for my values. Perfectly acceptable. Activist has come to mean getting involved with the board of directors and getting one of your people on the board of directors so you can make changes internally within a corporation. That's similar, but a little bit different than what I'm talking about. To me, it does not matter what the policies of a corporation are, who's on the board, what decisions they're making, how much money the chairman or the president is taking out, how little other people are taking out, how many women are working at that company. how many minorities are working at that company. All of that will come out in the price of the company. It will either be a well-performing company or it will be a poorly performing company. And it will come out in the fundamentals and the technicals. When you start playing around with activism in terms of changing the corporate culture, all you're going to do is change the trajectory of the risk and the reward of that company. You'll make it worse or you will make it better. I don't really care as a money manager. If you think you're going to make it better and you crack all of the eggs and stir up an omelet, maybe it's going to turn out better, maybe it's not. I'm going to wait to see what it does for the company. I'll give it a 50-50 chance that the activists that jump in and cause all kinds of problems and make the stock go up and down and fire a lot of people and put their own people in, it might work, it might not work. Flip a coin. I don't care. I would rather invest in something where you don't have an outside influence coming up and mucking up the works. It just makes my job easier until somebody comes along and mucks up the works. When a company goes through a merger, when a company takes over another company, when a company has someone coming on the inside and either trying to stir things up or not, I usually take that and move it aside, and it's not in my purview because there's so many clean investments that I can make where there's not this outside influence. Now, that's a little bit different. Leah, you have expanded the word value from the way I defined it versus growth to value, meaning the value that a person has or an activist has and how that changes the risk-reward balance of an investment. They can be the same thing.
And Tyler?
Yes.
And time perspective.
Yeah. What do you mean by time perspective?
Time preference of feeling comfortable waiting 10 years for Heinz ketchup or a blue chip stock versus let's just say Wall Street hedge fund activist investing perspective of wanting a return in 2 weeks because of taking that board seat and expecting a 10% share price rise and therefore shareholder gains.
Right. Again, the determination of potential rewards is a very, very simple calculation. It's not difficult. It's not complicated. You don't have to bring in all kinds of outside considerations. The higher the return, the greater the risk, period. On all assets, all asset classes, all individual stocks, the difference between growth and value. Growth stocks have a tendency to have higher returns than value stocks, but they are riskier. Riskier means more volatility in the price. More volatility means when things are going good, you get better returns. More volatility in the price means when things are going bad, you're going to lose more than you would on a value stock. That's true across the entire spectrum of investments. That's why in the crypto space, I have said from day one that Bitcoin is the king because it holds all the marbles. Everything else is riskier with less potential long-term returns because many of them will go out of business. When you look at cheap stocks that are very volatile in terms of their price movement, pink sheet stocks, over-the-counter stocks, stocks for selling for less than $5 a share, they tend to move up greatly and down greatly. So there's a lot of volatility. if you happen to be a gambler or a speculator and a technical analyst on a very short-term basis, you can make a lot of money. And there's people that specialize in doing that. But you need to understand that the risk of going after that additional reward is going to mean that you are going to lose a lot more money than you would if you took less risk. If you're very good at what you do, you can control the risk through money management. But in controlling the risk, you will personally be reducing your potential long-term reward. By controlling risk, you reduce your reward. If you put all of your money on black in roulette and it comes up, you're a big winner, but you better walk away. You better take the money and run, because you are going to give it all up over time. So from a money management point of view, before you enter your trade, you take the dollar from under the mattress. Before you do that, you have to decide the amount of risk and reward you're willing to take. You look at the asset that you think you want to get into, you do the technical analysis and the fundamental analysis, and now you understand. You have not yet put your money to work, but you now understand what the risk reward is of taking that money and putting it into that asset. And to the extent that you do that, you should take your position size based on the amount of risk and reward you are going after, knowing that you are going to diminish the amount of savings, the amount of checking, the amount of assets you have by the risk side of your equation, and you're going to add to it by the reward side of your equation. So that is the answer. It depends on the asset class, number one. It depends on the risk reward of that asset class, number two. It depends on the risk reward you are willing to take with your money, and therefore you've got to vary the size of the amount of money you are going to put on that asset. And once you've done those three things, go have at it.
Awesome. Regarding this conversation about risk and reward, how should you determine what type of trader you are and should potentially be? And can you define the terms of day trader, swing trader, and investor?
Sure. It's easy to define those things, but you don't know that today until you have tried them all out. And unfortunately, in the crypto space, we've got a huge proportion of people in crypto that are novices in investing. And that's unfortunate, but that happens when people jump on bandwagons with only a limited sense of what risk and reward are all about. But markets have a wonderful way of teaching. Everybody that goes through it goes through the same thing. I've gone through it over and over again in my career, not understanding what I was doing and getting rewarded for it and then getting punished by it. You want to limit the unknown as best you can. Okay, what do I mean by all that? The only person that can tell you if you are a gambler or a speculator or a short-term trader or a day trader or an investor is you yourself. Maybe a spouse or significant other will affect that final decision. And that decision can change over time for you. Everybody is an investor but doesn't know it. Everybody is a speculator and gambler that doesn't know it. And you've got to figure out where you are in your life, how much of that pot that you have you're willing to put at what level. if you put it all on a speculative item like Bitcoin and crypto, you are a fool. And define that any way you want. I define a fool as someone that should know better. But what you've just done is you've bought into a story that might work out, and you've put everything into it, and you refuse to think about it from day to day, week to week, month to month, year to year. And we will see how that works out. It might work out very well for you. If so, you've bought a lottery ticket and you've won. Congratulations. You are a fool. What money management means is if you are in something very risky, very volatile, don't put more than your pot will allow you to put in and lose it all and still feel good about your pot. That's what it means. It also means don't put all of your money in a pot into something that does not grow, into cash or a money market fund or a CD or a savings account. That will change once CDs and savings accounts are back up at 5, 6, 7, 8%. But that statement is a correct statement. You are a fool if all of your money is sitting in the bank, because you could have been making 10, 12, 15% per year in very almost riskless investments over the last 10 years. So the fool part is not a comment about you or your character. It's about the decisions you are making that are foolish decisions. I am a fool because I make many foolish decisions. Someday, I hope not to be making all those foolish decisions. I'm not talking about investments. I think after 40 years, I make very few foolish investment decisions. But I make many, many, many other foolish decisions, and therefore I am a fool relative to those decisions. That's all we're talking about. This is not calling you a fool, meaning that everything you do in your life is foolish. It's about this subject. Okay, so both extremes, either not putting your money to work intelligently, which Leah and I spent an hour or 2 hours talking about in terms of retirement accounts. And we can't believe the response that we got. So grateful for that simple observation that they did not know or had not thought about before. You're a fool not to maximize your retirement account. $5,500 a year has got to be going into an IRA. $18,000 a year has got to be going into a 401k if it's available to you. And we go back and look at that. And none of that has to do with investments. That has to do with growing money on a compounded basis without the government getting involved, taking out taxes on dividends or interest or short-term gains or long-term gains. It's a very simple decision, but it's the first one you've got to make with that pot of money, because it's a no-brainer, because you could have that money sitting in cash in a retirement account and never have to pay taxes on it. Let it grow. But you're being foolish because you could be putting into assets that are going to grow and not have to pay taxes. Okay, so today on both sides of the equation, being too risky for the amount of money that you are really willing to risk. And you won't know that until you get slapped in the face and all of a sudden you made all the right decisions in a hyperwave that was going up and all the wrong decisions in a hyperwave that were going down, because you decided for your own beliefs that this magical thing was going to work out for you. And even today, after losing 3/4 of what was in your account, you are still telling yourself, well, okay, it's just another 1,000, another 1,000, another 1,000, if the technicals are correct on this subject. Or you've got your own fundamentals and technicals that say 5,000 or 6,000 is going to be the low. And now I've made that decision. So I've ridden it down from 20,000. I should not have, but I did. Now the magic is going to come back. Okay. That's your thought process. And if you are qualified to make that decision at 5 or 6 or 7,000, if you're qualified because you know what you're doing, and you can put a risk analysis on that decision, that's wonderful. You may turn out to be right or wrong. I may turn out to be right or wrong with 40 years of experience on various technical things, because even the best technical thing, Hyperwave, sequential systems, and many others are wrong a proportion of the time. None of this stuff is perfect, but all of this stuff is knowable in terms of the risk and reward and the probability of being correct. That's what you need to know and think about. And always go with the probabilities on every decision when you are taking that money out of a safe investment, US dollars. True, US dollars have been devalued by 95% since World War II. That's true. But that doesn't mean that it isn't a great place to park money while you're making a decision how you want that money to go into something else. Because that diminishment is compounded, but it's only compounded the longer you do that. I do not think people should be in cash most of the time. I think people should only be in cash if there is not an obvious asset class you could be in whose risk reward parameters on the day you're making the decision don't greatly favor the reward side of the equation. And that is almost true all the time. I like one of the things that is said on CNBC with Kramer, where he says there's always a bull market sometime. That's not true, but it's often true. It's most often true. Therefore, you should always be looking for those bull markets, because bull markets in any asset class are better than cash. You will find sometimes that I have taken my clients and gone to 0% weighting in the things that we had been in for a number of reasons, technical and fundamental, and gone to cash. I don't like to hold that for a long period of time, but I've held it as long as a year or 2 years because the risk side simply grew too big. And now I want to get back and sit back and not have to worry about it. Okay, so I think that's the answers.
I think so. And with that said, because it's been an hour and 15 minutes already, let's go to traditional markets. I am going to pull up oil, which we said we'd talk about. And it looks crazy right now. Yep. So this is going to be a fun one. This is also because I've wanted to ask it since we were talking about a little bit about oil, but we were talking about energy earlier specifically. Right. And even when we look at the chart, a question to you is, what do you think we should know about oil as a commodity from an investing perspective? One person asked, do you think we missed the boat? And tying this kind of with a bow of how we're talking about technical and fundamental, as we know, oil is extraordinarily affected by policy decisions, and there is a lot going on in politics for oil right now. So let's look at the chart, and I would love if you could potentially speak to both. If that's not too, we can keep the chart up as long as you'd like. Great. Cool. All right. Are you able to see it, Ty?
Yeah, this is WTI crude oil. That's West Texas. It's called WTI, means West Texas Intermediate. That's what those three initials stand for. What I'm going to do is I'm going to make this bigger so I can see it a little better. Boom. Got it. Okay. Have you missed the boat? Well, if you have not been in oil from $40 approximately, you've missed the boat. What does that mean, though? that means if you were trying to buy a barrel of West Texas Intermediate crude oil, you've missed the boat. But I showed you before that one of the worst areas in the market over the last 10 years has been the energy stocks. It was actually only 6 months ago, number 10 out of the 10 sectors, and number 1 out of the 10 sectors was technology. And I told you that as a sector rotator, I was beginning to lighten up on technology and putting that money into energy. Well, energy stocks are different than the price of oil. They are greatly influenced by it, but they're also influenced by many other things, like the price of natural gas, like the restrictions and regulations on pipelines, like the cost of exploration, like the movement by the environmentalists to divest of oil companies. None of that has a direct effect on the price of oil. The price of oil and almost all commodities are determined by the players in the oil market directly. Those that are supplying the oil and those that need the oil. The supply and the demand of the commodity. That's different than the supply and the demand of companies that dabble or spend all of their time in one sector of the energy. Energy and oil are not synonymous. Oil is a part of energy, but solar is a part of energy also. Gas is a part of energy. Nuclear is a part of energy, all of which go into the energy sector. Pipelines are a part of the energy sector. There are companies that simply build pipelines. They don't care who buys them and who runs what through them. They are great at going through all the regulations and getting pipelines built and put into place, and that's how they make their money. So you need to be very specific when understanding what part we are talking about. If you're talking about the price of oil, the biggest determinants of the demand for oil and the supply of oil are macro. They have to do with who's got the oil, who can get it out of the ground, who sells it, and who needs it. And the U.S. was in a very bad position for many, many years, mainly because, this is important, mainly because of the fools back in the 60s and 70s that limited our ability to increase our nuclear. Now they're realizing that the cleanest of all energies is nuclear. It's not solar, it's nuclear. And now to hit any of the targets we want to do in terms of the environmental movement, we've got to bring on nuclear plants all over the world as quickly as we can. And they're still by the same people that were arguing back in the 60s and 70s, making it very, very difficult to solve the one problem that they would like to solve. Okay, enough of that. But it gets into this whole idea of what values we hold and how long we hold them before we're willing to give them up and look at a bigger picture. Okay, so when OPEC used to be the controlling force on oil, the U.S. was a huge net importer, and we relied on many of our enemies to import our oil from. And then we got our act together slowly but surely. We developed fracking, we developed our gas fields, and we became balanced in terms of net imports and exports. And very quickly, we can become a huge net exporter of energy. There are consequences whenever you make macro decisions, and some of the consequences are negative. Many of them are positive. and you need to balance that out, and it takes society a long time to do that. But right now, we have weakened OPEC greatly because of the actions that we have taken and are taking under the past several administrations, and particularly under the current administration, in terms of not being reliant on foreign energy. Okay, but that is still the biggest determination of price. So we've dropped from $130 a barrel down to 40 almost overnight. We have gone from 40 back up to 70 almost overnight, meaning in a 1-year period. And that is typical of commodity pricing, particularly commodity pricing that is useful, such as the grains, the agricultural goods, and metals or energy that are used around the world. Gold does not fall into that. It has a different place closer to what Bitcoin has in terms of how it trades and why it trades. But just looking at this chart, energy stocks still have a long way to go to make up for years of underperformance. But the price of oil, it would not surprise me if the price itself gets stuck in a range between 60 at the bottom and 80 at the top for a pretty long period of time. That's assumptions based on me looking at a lot of charts and knowing quite a bit about this market. And we'll see if that's true. But with every statement I make at a point in time, I will change those statements as new evidence comes in. And that's something that each of you should do. You don't marry yourself to an asset class. You understand the asset class. You do your research on it technically and fundamentally as it stands today. And then with all humility, you are willing to change as new evidence comes in.
Thanks, Ty. All right, I'm going to move to gold. Tell me how, oh, actually we have silver. All right, we have gold here. Tell me if you're okay with this time frame. And I am going to run to grab an ice pack for my knee. So I'm going to leave you for a second. And with that said, then I'm going to evoke a broader question on this one, as well as what you're seeing in the market, which is if you could tell us your thoughts on the history of going off the gold standard, gold versus the power of the dollar. You are, I don't know if everybody knows this, but Tyler is an expert on this subject, as well as the Fed and what changed with the Fed. I will let you speak to any of these points. I left it nice and broad for you, but maybe we can start with the markets, but I will let you have it. I will be right back. You can see me on the screen when I come back.
That's great. And when Leah gets back, we will take a look at silver because a lot of people have been asking about that. Basically, where gold goes, that's where silver is going to go on a long-term basis in terms of directionality. In terms of directionality, not terms. Oh, there's an echo, which is probably Leah's mic.
That's mine. Hold on. I got it. I can handle that. Keep going.
Okay, great. Thanks, Leah. Okay, so gold and silver tend to move together in terms of directionality, but not in terms of percentage moves. Silver tends to move percentage-wise more than gold. It is more volatile than gold. But let's talk about gold right now because this is a very interesting chart. You know that a short period ago, I was very bullish on gold, but bullish from the perspective that I needed it to get above 3,800. And what I was hoping for is above $4,000. And it did not do that. We've got a big top now at that 380 level, and it's tested it on a number of occasions going all the way back into last year, well into last year at this $1,380 level.
All right, Ty, I'll be right back. You sound good.
Okay, very good. Yeah, I was saying 4,000 and 2,000. I meant 1,380, $1,400 the top. And I still believe that it is going to break out to the upside above 1,400 and start a move to all new time highs because of macro issues. However, this is doing just the opposite. And let's just look at Consensio for a second on the gold chart. We're looking at a that should be a 14 and a 30, and we've got a 2, a 7 and a 30. That'll work. Okay. What we have is we've got the short term breaking down below the long term. We've got the intermediate breaking down between the long term, and we've got the long term moving down. We've got the price below all of them. That's the definition of a bear market. And therefore, on the basis of that, if you have gold on some of our consulting clients, I've had them lightening up and lightening up as we get lower and lower without doing too much damage, because we're still up in the mid 1250s off of that original 1100 bottom. But at this point, you don't want to be in the gold market. This is different than the gold stock market. In other words, the miners, we're talking about gold prices here. Gold prices will lead the miners up and down, but the miners will move at 1.5 to 3 times as rapidly, volatility-wise, as the underlying gold price. So that's the GDXs, and that's the individual mines. GDX is an ETF that trades mining, gold mining shares. But right now, you always want as your anchor when you're talking about an asset class is to be the main thing in that asset class. What I mean by that is in the stock market, you can use the S&P 500 as your anchor. And then you can break that down into 10 parts, which are all different sectors. And you can break those sectors down into hundreds and hundreds and hundreds of other parts that are the individual stocks. But know what your anchor is doing. Know what the driver of the majority of things in that asset class are doing as your number one decision. And therefore for gold, and therefore for precious metals, and therefore for silver, the driver is the gold market. Bitcoin is the driver of the crypto market. Everybody fought that analysis all the way up. Oh no, my crypto is better than your crypto, and this crypto is better than that crypto. And what Leah and I have maintained from day one is there's only one, which is the king, the anchor, and that's Bitcoin. Everything else will follow, both up and down. And on the upside, many of those will do better, just like many mining shares will do better than gold. On the downside, most of them will do a lot worse percentage-wise, just as in the downswing, many of the cryptos. There's an article today that 1,000 of the cryptos have gone to zero. I haven't confirmed that yet, but I have been predicting it. And I've said that the bottom in Bitcoin will come when 95% of all the junk has gone to zero, meaning gone out of business, and basically won't give anybody the time of day for putting money into it. And we are not. Yes? Yeah. Okay, good. How about pulling up the silver market?
Let's do it.
And if you could make that longer, make it weekly, and that's perfect. Okay, that's great. Okay, so here's weekly silver. And you see this drop. I can't read the price on the far right. Where did it close? 15? It
closed at 16.
16 approximately. Okay. What I've been saying, and where is the low back in, what is that low in in July of,
Here,
yeah,
15.
that's 15.
You want me to throw any of the moving
Go a little bit further back.
averages? Oh, yep.
Okay. Perfect.
Looks like 13-ish. Can't see so well either, but
yeah. Okay. Basically, just looking at this silver chart, what I see is the bottom in 2016 at maybe just put your pointer over that low point, and let's take a look at the high-low close. 1360. Yeah, 1350 has been kind of what I've been thinking about as the low point. And what that means is you better not have any if you go below that, because it's probably going down to 6. And if it's going down to 6, then gold is probably going below 1,000, taking out new lows. But in any case, gold is the driver, not silver. So just looking at this chart, I would draw a bottom. It looks very similar, doesn't it? In terms of what we've been looking at Bitcoin, meaning this run up from the bottom to the top from 13 to 20, let's say 13 to 20, and then this correction down, and now this sideways movement is very Bitcoinish looking. So if you were to draw a line, Leah, I don't want to cause any problem here, just approximately on these 3 bottoms in 2017.
okay.
Just a horizontal.
All right, hold on. You
I'm
want
getting-
the 2017?
Yeah, I'm getting seasick.
I know, me too.
Yeah, in 2017, see those 3 bottoms down in the
Yeah,
15.
I'm bringing them up. Hold on.
And you can't, the one in the middle is lower, but just forget about that. Take the one on the left at the beginning of 2017. Yeah, use that as the bottom and just draw a horizontal line. Perfect.
You just want it straight through is what you're asking?
Straight through. That's beautiful. Okay, there's your line, folks. Below that is trouble. But at the same time, there is the possibility that if we can turn up from here, and I'm going to ask you to just draw one other line, which is a descending line. And we will start it in 2017 at that peak, right about where right there. And just connect those tops.
Tops.
Yeah, perfect. Right there. That's good. Okay, so that's what we've got. That always look at the big picture first. And we did that by looking at the movement from 13 all the way up to 20. We've still got the 20 in the picture, but now we're in a consolidation. So the first is the big picture. The second is the intermediate picture. And it's in this descending triangle with a horizontal bottom and descending tops. And that has got a 50-50 chance of breaking either way. But if it came out of a move from a bottom like this one did, this entire move basically was from $6 up to 44, and then all the way down to 13, and now up to 20, and now this consolidation period. You don't want to be in this if it drops below the horizontal line. If you miss that or get caught in it, you definitely don't want to own this if it drops below 1350. Unless it does both of those things, you're fine in this consolidation pattern, but we're getting pretty close down there. Gold is already broken to the downside and is in a bear market. We only have a 30-week moving average on this, but the price is below that. And it's been above and below that over and over again for the past 6 months. So you can picture where the short term and the intermediate term is. I don't need to look at it, but I can picture it because of this recent 3-week action to the downside. You know that the short term, the price is cut through both the short and the intermediate term. And it's now below the long term. So this is not looking good. I would be out of it. I am going to get my discretionary clients out because of the way this dropped on this past week. We have cut our positions in half. I'm going to cut them down to 0, and I will simply wait. We do not short for our discretionary accounts. So I'm not talking about shorting anything. That is a different discussion, and we will have that at a different time. I'm talking about getting out and putting the money either back into a better asset class or back into cash. I always start in cash, which gives me time to look for better asset classes. I would rather be fully invested at all times in some asset class that is doing better than cash. But there are periods of time that you will find there are none, or the ones that you can pick from are so volatile that you only want to use some of your cash, not all of it. Okay, so that's my view of the gold and the silver market.
Cool. I did go on those moving averages. Hold on.
Okay, great. And you can see that they are much flatter, as I predicted they would be, than the gold. If you just want to switch back to gold for a quick sec. The gold, you can see how the short and intermediate term are dropping.
And Ty, just so you know, I have the moving average here on 7 for gold, and I had it on 14 for silver. I can switch to
no problem. Everybody needs to be able to mentally move those moving averages without having to physically do it. When you know you go shorter, lower and lower numbers, it's going to be more volatile. As you get higher and higher numbers, less volatile. So you should be able to picture that. That's what Consensio is all about. And then just work your best fits in with various asset classes. I love the ones that I'm using now. That will change over time. But in any case, the principle's the same in all of them. But you notice how the gold long-term moving average is just flattened out and slowly rolling over. That can easily go back to an uptrend, but it is not right now. And it's on that basis that I will be exiting this week the gold market. Again, we are not talking about gold mining shares. We're not going to pull those up right now, but we will talk about those this week coming up.
Dow.
Okay, Dow Jones Industrials. Not looking pretty.
Also on the 7. Just let me know if you want me to switch anything up. But yes,
no, that's
it is fine. Not.
We've got a 2, a 7, and a 30, and we're below all of them. So the Dow is not looking good. We talked about that in our last call. The Dow to me is not the most important, but it is important. The S&P and the NASDAQ, because the NASDAQ was the strongest, it's the most important, but over time the S&P, because it's both growth and value, both small or all 3 small, mid, and large cap, and tend to be very high quality companies in general. That's the one we're worried about. Let's take a look at the S&P.
Mm-hmm.
It has not broken down above the, it's still above the long term, but notice that the intermediate term is turning down sharply, has broken through the shorter term. The shorter term is turning down. Tone said last night or early this morning, this week coming up in the stock market is very important. I would agree with that. The Dow is already looking bad. And bad in the stock market is not a good thing. I'm not saying looking less good. I am saying bad because of that formation on the Dow. The S&P is still okay, but you are not going to get the Dow dropping sharply unless the S&P also rolls over. So the S&P might save the Dow, but right now the Dow can be toxic to the S&P, and that should be resolved this week. I am nervous, and that will mean that I will be raising cash in my accounts. Let's take a look at the NASDAQ and just see what we got going there.
Yeah. 100 or composite?
The 100's fine.
Okay.
And because it just went up and hit new highs, that is the strongest of the three, the Dow, the S&P, and the NASDAQ. We had that little doji a week before this past week. And unfortunately, that is signaling a couple of things to me that I need more information about, but we could still be influenced in the NASDAQ market by the broadening top. And I'm going to do some work on that tonight with various individual stocks in the NDX 100. But that action on Friday, the close of the week, was not good. Was not good for the S&P, was not good for the NASDAQ, and clearly was not good for the Dow. So my view of the U.S. stock market, and therefore of all the markets of the world, has gone into a confused state, and I don't like to be confused. So what I do is I take each piece separately and don't make assumptions about all of them together. I've given you my conclusion on the Dow. If the S&P drops this week, it will become negative in my mind, and that will very probably mean the NASDAQ will follow. And that means that the boulder has begun rolling slowly down the hill. That gives you a lot of time to make decisions. And the way you make those decisions is one piece at a time. And we will be doing that in the coming days and weeks.
So Ty, we're coming up on an hour 45. Let's finish with Bitcoin.
Okay. I'm going to, if you get out of your screen share, I will pull up my screen share. We will look at Bitcoin because it had that surprise.
I am off.
You are off, which means I can get on and I can go boom bada, boom bada, and I will do this boom bada, and I'm in. I think so. Now I go here, and then I make this bigger by going here. Okay.
Good.
So this is the one we've been using. This is the entire Hyperwave right down to yesterday, this morning. And we've got a green candle now on the far right. We are stuck between two Fibonacci numbers, the 78.6, which comes at 49.93, and the 81.30, which comes at 61.8. Tone pointed out that it would be different if I was using 0 as the bottom. I'm not. My 0 line is 1,000 in terms of the retracement up to 19,666. And I thought about what Tone had said, but I'm going to keep 1,000 as my bottom because that's the phase 1 line of my Hyperwave. And just for Bitcoin, that makes the most sense to me. Okay. So let's take a quick look at what happened yesterday by looking at one other more specific chart, which would be this one. You probably can't see this one. Can you see this, Leah?
Oh, I'm still on mute. There you go. Nope.
Okay, so that
crunched up.
Okay, so I can fool the computer. I'm great at doing that by going here.
Because you're so tech savvy,
Going, no, I wouldn't go that far. But I've learned how to fool the computer sometimes. Okay.
Boom. Looks good.
Okay, great. So now what we're going to do is we are going to look at a 4-hour chart because of this. The last 1, 2, 3, 4, 5 4-hour, 20 hours ago, 5 o'clock last night, we had this big spike. Now, it is true that last night was Friday. Options and futures close on Fridays. But more importantly, you've got things called witching hours or triple witching hours, where options and futures on options all trade at this close at the same time. Yesterday was an interesting day because it was the last trading day of the month for the futures market. And that means that the Bitcoin futures at 5 o'clock last night closed the June contract. And that just happened to be about the time cash Bitcoin took this big jump. Well, Tone did an explanation this morning that was very good. And he was getting into the weeds a little bit in terms of difference between open interest and volume on futures contracts and how it's very different on financial futures. And I considered Bitcoin to be a financial future as opposed to commodity futures like agricultural and that sort of thing. But in any case, there is the possibility that the close of the June CME Bitcoin futures market, 5 o'clock yesterday, coincided with a brief volume spike in the price of cash Bitcoins. I will not try to explain why that is, only that it is a very possible reason for that spike. Now, if the spike had continued, which it really didn't, as you can see that the last 3 4-hour bars haven't gone anywhere. They've all been below the high of the second 4-hour spike, which doesn't mean it's not going to go higher from here. It doesn't mean that this will not start some kind of movement up to 7,000 or higher. Maybe we've seen the lows on Bitcoin. Maybe my phase 2 is not going to be touched at 5,000, 4,900. But I doubt it. The probability is still as I have stated. And I continue to believe the short-term next 5% move probability is to the downside, not the upside. So I'm keeping at this level, 6,400, I'm saying that my next 5% down is, my next 5% move is probably down from this level, which is about 300 points, only takes us down to 6,100. But I'm maintaining my original short-term downside target at 5,300, even though the 5% move I was looking for got us from 6,200 down to 57, which was a 5% move, but it did not hit my target to the downside. So bad on me that my target was not hit off of the 5% down move that I did correctly predict. But by holding on to that 5% short-term target, I turned out to be wrong because of this spike that we saw, but I'm maintaining it because from this level of 6,400, I do not have sufficient evidence to believe that the next 5% move is going to be to the upside. I might move to neutral depending on what from this point forward holds in terms of evidence. Because if the next 4-hour time frame gives us something differently, either flat or up, probably flat, I might begin to conclude that I do not know where the next 5% move is going to be, and I will change to neutral. I would not change to positive regardless of what happens, because I always like to go through that neutral zone, which tends to last for a day or 2 days or 3 days or 4 days between pulses. I look at this as an upward pulse from 5 o'clock last night. And it meets all the requirements of that pulse, which means it's now in the flat phase. So the flat phase following a pulse, either up or down, is a time to gather evidence about the next pulse. And that's where we are right now. So nothing has changed for me, short, intermediate, long-term to the downside. One possible explanation for the spike, it might be correct, it might not be correct. It could be a number of other things. Could be like all the other spikes that had nothing to do with the futures. Or as some people have pointed out, there is an interesting thing that goes on around the time of futures contracts coming to a close and new futures opening up. And I haven't had time to study that. So that's my look at Bitcoin. Thank you very much.
One more.
Okay, good.
Also, the game just ended for you guys that are watching, and it was bananas. Bananas. It looks like people are doing spoilers in the live chat, but for whoever's not in the live chat, I will not say what just happened, but crazy. People have been asking about GBTC. So can we just really quickly, before we hit an hour, so I'm going to give you 3 minutes, talk GBTC?
Okay.
I'm pulling it up on TradingView.
Okay, very good.
It's up.
I disagree with those who have been saying that it's impossible for GBTC to lead Bitcoin prices. I 100% disagree with that. And I understand that some of the people making those postings have been trading GBTC for a long time. They know GBTC. They know all the same things that I do about the relationship. They know about the premiums and the discounts. A lot of people don't realize that we have had discounts to the price of Bitcoin on GBTC in the past. And I believe we will see discounts again in the future. But having said all of that, I disagree. I have seen and I have profited greatly from realizing that GBTC prices often, not always, but often lead Bitcoin prices. That is not anything having to do with the fundamentals of the connection between the Bitcoin investment trust and Bitcoin prices. That has to do with very large institutional players setting up what they are going to do in the Bitcoin market by doing things in the GBTC market. That's different. Tone says that's not manipulation. He and I have looser or tighter definitions of manipulation. I think when a big boy can move price, that is manipulation, but it is not illegal, as opposed to what is clearly fraudulent manipulation, which is illegal. But my sensibilities require me to know that in a market that there are players that can move price. You need to know that. You need to know that the Bitcoin price can be moved up or down regardless of fundamentals or technicals by individuals. That's because it's so thinly traded, it's so new, and the disbursement between those having huge amounts of money and those that do not puts Bitcoin into a bucket in which you must know that that is the case. You must also realize that GBTC has the ability because of the way it is traded, of moving to large premiums that can be moved by very large players, institutional players or individuals. So what that means is if somebody that has billions at play can move the premium up by buying GBTC and shorting Bitcoin and not really risking the spread, but moving one part of the equation. And then when that GBTC is up there and you get FOMO going on, then taking the short side of the Bitcoin off, and Bitcoin then catches up with GBTC. That's what I mean by leading. It's not leading because of the mathematics. It's leading because of the imbalance of supply and demand factors between the two. And if you know that, realize that, understand that, and chart that, you can come up with your own rules of the best time to be in or out of GBTC. Not the best time to be in or out of Bitcoin, but the best time to be in or out of GBTC, which to me is marvelous. And with that, thank you very much for listening, and especially when the game was going on. And if you didn't, when the game is completed, which it looks like we now have.
It is.
And what was the final score?
4-3.
And who won?
Sorry, not who you wanted.
Okay. I will watch it. Thank you all very much, and keep your questions coming. We will do this more and more frequently. And thank you very much, Leah.
Thanks, everybody. Have a great day. Enjoy your weekend.
Bye-bye.